All right, welcome to The Explainer. Today, we're throwing on our professional equity analyst hats to crack the financial code of Brookfield Infrastructure, ticker symbol BIPC. We're going to navigate some incredibly messy, contradictory data to calculate this stock's true intrinsic value. Because honestly, when you look at the raw numbers for this company, it feels like looking at two completely different businesses at the exact same time. Our job is to cut through all that noise.
Here's our analytical roadmap for today. We're tackling the BIPC financial puzzle, hitting absolute and relative valuation models, checking out the asset-based valuation, and finally, synthesizing all of that into a definitive intrinsic value.
Part 1. The BIPC financial puzzle. Let's make sense of some really deep contradictions.
Right now, BPIC is trading at $37.09 a share, which brings its market cap to roughly $4.45 billion. But as analysts, we can't just take that price tag at face value, right? We've got to ask, does the underlying math actually justify that number, or has the market gotten way ahead of itself?
And wow, the data here is just a brilliantly messy contradiction. On one hand, you've got massive trailing revenues, over $3.6 billion, an incredible gross margin right around 82.7%, and a super attractive dividend yield near 4.9%. But then, you look a little closer. Negative net income of $241 million, trailing free cash flow that's practically a ghost at just $2 million, and a severe debt-to-equity ratio of negative 10.21. Basically, it's a high-revenue, high-yield machine that is technically bleeding money and swimming in liabilities that just wipe out shareholder equity on paper.
Moving on to Part 2, absolute valuation models. We're talking DCF, DDM, and residual income. Now, the bedrock of any absolute valuation is the discounted cash flow, or DCF model. In plain English, it calculates what a company is worth today based entirely on the free cash it's going to generate for its owners in the future.
Here's how we actually build it out. Step 1, we project out those future free cash flows to the firm. Step 2, we discount them back to present value using the weighted average cost of capital, the WACC, to account for risk. And Step 3, we tag on a terminal value to capture what the company is worth into perpetuity.
But man, we hit a massive speed bump here. Remember that $2 million in starting free cash flow? Well, the trailing 12-month free cash flow compound annual growth rate is actually negative 99.41%. Because that starting cash flow is basically zero and shrinking, an analyst has to step in and assume some incredibly heavy normalization. We're talking inventing a massive future turnaround, assuming a standard 5 to 6% market risk premium, and slapping on a default 2 to 3% terminal growth rate just to force the formula to work. That makes a traditional DCF highly sensitive, totally speculative, and honestly, incredibly fragile for BIPC right now.
Since the DCF is just too fragile, we've got to pivot to our second absolute model, the dividend discount model, or DDM. Instead of trying to value the whole company's wobbly cash flow, the DDM focuses purely on predicting future dividends paid directly to shareholders and discounting those payouts back to the present. For a high-yield infrastructure stock like this, it's usually way more reliable.
And here's where things get really interesting. Despite the negative earnings, BIPCO has actually hiked its dividend for 6 consecutive years. They've maintained a remarkably steady growth rate, right near 5.9% across trailing 3-year and 5-year periods. That gives us a beautiful, highly predictable input to work with. So if we take that rock-solid 5.9% dividend growth rate and apply a standard cost of equity discount rate to value those expected future payouts, the math gives us a firm fair value price of $31.73 per share. Finally, a solid, math-backed anchor driven entirely by reliable cash returns.
Normally, we'd want a third absolute model to double-check that DDM finding, right? The residual income model is usually perfect for this. It calculates intrinsic value by taking the current book value of equity and then adding the present value of future residual income. But we run into a brick wall immediately. BIPC's equity is deeply, deeply negative. We're looking at a price-to-book ratio of negative 3.80 and a return on equity of negative 18.55%. Because the liabilities on paper completely swallow the assets, this model just outright breaks. You literally cannot build a house on a negative foundation without a massive forensic reconstruction of the balance sheet. So with one model fragile, one strong, and one completely broken, let's see what the broader market thinks.
Part 3. Relative valuation multiples. Let's compare BIPC to the market.
Well, wouldn't you know it, BIPC throws another winch in the gears. Traditional equity multiples, practically useless here. The price-to-earnings, or PE ratio, is sitting at negative 25.58 because of that $241 million net loss we saw earlier. The forward PE is literally zero, and the PEG ratio is negative 0.35. You just can't value equity relative to earnings when the earnings simply don't exist.
To get around this, we're forced to look at enterprise valuation multiples. These look at the whole firm, totally ignoring the specific capital and debt structure. And suddenly, a totally different story emerges. An EV to EBITDA multiple of 5.46 and an EV to EBIT of 7.08 actually suggests the core operations are priced pretty cheaply for a capital-heavy infrastructure company. Operationally speaking, it actually looks undervalued.
Part 4. Asset-based valuation. Calculating the net asset value, or NAV.
To calculate the NAV per share, an analyst has to add up the fair market value of every single physical asset, the pipelines, the power lines, the toll roads, the whole shebang, and then subtract absolutely everything the company owes.
The data tells us the enterprise value is reasonably supported by those physical assets, with an EV to assets ratio of 0.66. But then, you look at the liability burden. A crushing debt-to-equity ratio of negative 10.21 and a painfully weak current ratio of 0.38, which means short-term liquidity is a real issue. Those liabilities vastly outweigh the assets, which drives the true NAV per share well below zero. So if you are looking at this as an asset liquidation play, there is absolutely zero margin of safety.
Finally, Part 5. Synthesizing intrinsic value. Let's get to the final analyst verdict.
Let's synthesize all these models. The DCF and asset-based models totally break down thanks to that negative free cash flow and crippling debt. The relative multiples suggest the core operations are cheap, but they completely ignore the stark risks sitting on the balance sheet. That leaves our absolute rock in this case study, the dividend discount model. It provides our most reliable anchor at $31.73. We have really high confidence here because it's backed by 6 straight years of actual, tangible payout growth.
Look, investors primarily buy infrastructure stocks like BIPC for their yields. Because of that, we have to weight the dividend model heavily in our final synthesis. Therefore, our calculated intrinsic value lands firmly at $31.73. When you compare that to the current market price of $37.09, we're left with a negative 16.89% margin of safety. Analytically speaking, the current stock price is noticeably overvalued.
So, the crucial takeaway is this. Looking at BIPC is like watching a massive financial tug-of-war. On one side, you have incredibly steady cash dividends and phenomenal gross margins. On the other side, deeply negative equity and practically zero free cash flow. The hard data suggests you'd be overpaying right now. So you have to ask yourself, are you willing to pay a premium above intrinsic value just to lock in that steady 4.91% yield? Or does a debt-to-equity ratio of negative 10 make this infrastructure foundation simply too dangerous to touch? That is the ultimate question for your portfolio.